Well, welcome everyone, and hello. Thank you for joining this executive roundtable to discuss the impact of COVID-19 on venture capital funds, where we've been and where we're going. My name is Tom Muscarella, and I'm a consulting CFO and the practice leader for our fund administration group. We provide full service fund administration to venture capital funds, as well as their GP and management company entities. We've earned a very strong reputation for helping emerging managers and debut funds to navigate through the startup process. Additionally, Krantz has been the go-to financial solutions and outsourced accounting firm for startups for over 25 years. Over the last few years, we've supported over 1,000 satisfied startups from seed through exit, as well as meeting the needs of their VC or PE investors. Whether you're focused on operational accounting, strategic finance, fundraising, M&A, or audit, we know how to turn your entrepreneurial innovation into superior valuations. We've put together a group of expert panelists for today's webinar, and they'll provide interesting and diverse views on the subjects we discuss. In addition to being really smart venture capitalists, we have a lot of athletes as well, a couple of college football players and an ultra marathoner. So I'll start with Matt Nordgren of Cadence Capital, a firm based in LA that invests in growth stage cannabis infrastructure companies that don't touch the plant. We have Marcus Stroud of TXV Partners, a Texas and San Francisco based firm investing in early to mid stage companies in enterprise software and consumer products and services, with a particular focus on health, fitness, and wellness. Elizabeth Wheel of Scribble Ventures is here, and Scribble makes early stage, that's pre-seed to Series A, investments in technology companies. And we have Homan Nguyen of Fusion Fund, an early stage investor in the industrial, enterprise, and healthcare application spaces. I'm going to ask each of them now to do a little introduction of their own background, and we'll start with Matt.
Hey, thanks, Tom. I'm glad to be here with everyone and all the attendees. Thank you for taking some time to listen to us today. Hopefully we can be helpful. You're probably in the fire just like we are. So if any perspective is useful to you, we'd be glad. My name is Matt Nordgren, as Tom said, with Cadence Capital and Cadence Fund Management, founder and CEO. We have about 40 companies we're involved with today. We are a growth investor. We don't really do seed or angel investing. I think A round is probably a good entry point for us, or something between an A and a B. We focus specifically on the botanical wellness space. Cannabis and hemp are the two most prevalent emerging industries within that category. But similar to some of our friends here, we really do look at wellness and health as a macro category, and cannabis and hemp are the ones we focus on today. We do focus on ancillary companies that don't touch the plant in their business on a daily basis from a risk standpoint, de-risking a hedged and diversified strategy. And with 25 million fund and 100 million fund and about 10 SPVs with companies that do touch the plant. So we will on a one-off basis.
Thank you. Marcus, you want to give your background?
Sure. Hey everyone, my name is Marcus Stroud. Howdy from Austin, Texas. Our office, like Tom had said, we're based here in Austin with a presence in San Francisco. We actually focus on the U.S. and Latin America. Like Tom said, our focus is early stage enterprise, BB/SaaS, as well as human performance. Like Tom also mentioned, I'm a former athlete myself. A lot of our LPs are sports team owners, sports team themselves, strategic entities that invest in healthcare and sports technologies. As well as enterprise technologies. We're a $75 million fund. Yeah, that's kind of it. Like, we focus on seed, Series A, Series B. We have about 6 SPVs. Yeah, that's TXV in a nutshell.
Thank you, Elizabeth.
Elizabeth Wheel, founder and managing director of Scribble Ventures. And Scribble is a new fund, but essentially being the extension of the investing that I've been doing for the last decade. So we are focused on pre-seed, seed, and opportunistic A, have a big pool of reserves for follow-ons. Background prior to that, after Stanford, was at Menlo Ventures and Institutional Venture Partners. Was an early employee at Twitter for 4 years. and through a hyper growth phase of 50 to 2,500 employees. Spent time at Andreessen Horowitz for 4 years, building out a team called Market Development, essentially connecting Fortune 500, Global 2000 to our portfolio companies, with the end goal being business development relationships and revenue. Then went on and took a general partner role at a firm called 137 Ventures, focused on structured secondaries, and realized throughout this time, I'd been fortunate enough to angel invest in founders we worked with, engineers we knew, and had built a strong portfolio and spun out on my own about a year ago formally. And as far as Scribble goes, at the beginning of COVID, so I have been an entire fundraise done via Zoom, and currently closing about a $45 million fund focused on the areas I mentioned.
Thank you, Elizabeth. Homan?
Hi, yeah, I'm a partner at Fusion Fund. We're based in Palo Alto, California. We like to look at companies, I would say pre-seed, seed, early Series A as well, in the industrial, enterprise, and healthcare sectors with some sort of core technical or data differentiation. And a lot of that comes from the fact that both myself and my partner, Lu Zhang, who have technical degrees. We've done our own technical startups, run them, started them, sold them. And so that's kind of where the DNA for the firm comes from. I invest all through the United States and Canada. And yeah, unlike I think everyone else in the panel, I'm not a elite athlete, so I'm behind every one of that. But yeah, just like Elizabeth mentioned, we're also fundraising purely virtually, so it's an interesting experience to encounter that on both sides of the coin, so to speak.
Great. Hopefully we'll touch a little bit more on that subject. So thank you all for that background. Let's get started. For those of you listening, we're going to try to leave a little time at the end of our discussion for Q&A. But feel free to use the chat function, and if we can address questions as we go, we're happy to try and do that. So on a little bit of background, we all know that COVID-19 has had a significant impact on our economy and venture-backed portfolio companies. One of the first reactions of VCs was to reach out to their portfolio companies to recommend ways for them to find to extend their cash runway. That led to scaling back expenditures in areas like marketing and also led to rifts. Some industries benefited, such as online retail, telehealth, pharma, while others suffered, like travel, hospitality, and entertainment. So I'd like to start by asking the panelists, do you think these trends will have any permanent effects? Who'd like to start? Matthew, would you like to start?
Yeah, I think they will, but it's going to depend on your strategy in a lot of ways, because depending on how you invest, you could be less attractive now than before. And I think for our case with the cannabis and hemp space, we've seen a dramatic increase in revenue and growth during COVID. And so for us, I think it's been a little bit different journey. I'd be curious to hear some of the other panel's thoughts on their strategies too. Yeah, but for us, it's been actually a positive. And I think the only change is that we were deemed an essential business, which allowed us to operate just like a grocery store or pharmacy, pretty much in every location throughout the country to some degree. So, and the other thing I think that was impactful there to mention, Tom, is that we didn't have the ability to sell products in any other environment other than those environments anyway. Unlike alcohol or tobacco or some of these types of consumer products that, with no events and forums with which they can sell, commercial product, they did lose a significant amount of revenue, even though they had a bit of an uptick in delivery and maybe in-store curbside pickup. We as an industry did not have that ability, so we didn't lose anything, and we were able to maintain what we had and figure that out. So I think we've been able to maintain a pretty attractive, as an opportunity for allocators. And I think that we have to wait till November to see what that real impact's going to be for our industry.
I see you shaking your head, Homan. Do you have a comment to add to that?
No, I was just saying, I think, COVID has really accelerated a lot of trends, which I think have always been in progress. So, I think we're seeing some acceleration several years ahead of schedule in terms of, digital transformation and things like that. So a lot of our businesses, because they are more B2B oriented, have also benefited from COVID. And I think that we're going to see that trend continue. I don't think there's going to be destruction of industries, but I think what businesses and what business models work will be changed. And I think, with COVID, everyone being locked at home, people are wondering like, well, why did we do things that way before? It doesn't really make sense. So let's adopt new tools, new technologies. And I think that's what we're seeing a lot. And, the stock market is really showing that a lot of the, tech related companies are accelerating, whereas other industries, I think, may be suffering a little bit until they readjust to the new normal.
Yeah. How about you, Elizabeth? Do you see that any of the portfolio companies are kind of switching models to adjust to COVID?
Well, one of the biggest macro trends that we're seeing across the portfolio, a few things, especially within the pre-seed and seed. First, these companies are so low burn traditionally that the cash that they already have can withstand this period, and it's actually providing a great benefit, being able to be heads down. And then I think even more importantly, we're seeing this geographic unbundling, and these remote teams that have been very unique in the past are now turning into the norm. And I think it's not only accelerating the progress that these companies can make, but also the creative ways that we're getting our jobs done, in addition to the ability for people to be spread out geographically. And now just really creating a lot more diversity of thought, the way even products are built because of these different perspectives. So I'm really, one of the reasons I did not want to lose a beat on this period of investing was at the stage that we're focused on. I've only been deploying at, actually a quicker pace than I expected and then that I was prior.
Yeah. Marcus, you're in Austin, Texas. How are you seeing deal flow and the geographic diversity? And was that changing before COVID, or has it changed because of COVID, or has it accelerated because of COVID?
Yeah.
It used to be back in the day, a lot of the Silicon Valley venture capitalists used to try and draw companies into Silicon Valley in order to fund them. But there seem to be companies all over the country now.
Yep. Yeah, that's a great question. I think, kind of touch on the previous point, we've seen definitely a change. So on our B2B software side that we invest in, we try to invest in companies that are, changing legacy technologies. So think about airline software, think about supply chain. And so we're seeing a ton of changes in that because so many of these companies are now like, we need to reduce burn. We need to, migrate to a more modern kind of focus. And so we've seen a massive uptick in our B2B software side of things. And then as well as our health and wellness aspect, I mean, that has just exploded for us. The 3 portfolio companies in particular have done very well as a result of COVID. And so we've been very grateful for that. But as far as the kind of migration to Austin, yes, yesterday we talked to 2 unbelievable entrepreneurs that just sold great companies in Silicon Valley that have now forced their teams to move to Austin. And like I was telling you guys on our pre-call, someplace in Idaho, I cannot think of the name right now, but that is becoming a weird tech hub. This place in Idaho, you guys may know the city, but we've seen a lot of folks choosing between Austin and that particular city. And so I think Austin offers a really cool alternative to Silicon Valley and New York City in the sense that Texas is cheaper. Austin's super cool, it's super weird and super laid back. Matthew's very aware of that. And so for entrepreneurs, it's like,
great music.
Okay, we just raised a $2-3 million seed round here in the Valley. We want to make sure this capital can last as long as possible. Let's just move everybody to Austin. I think the problem, though, that a lot of entrepreneurs from Silicon Valley are starting to see as they migrate to places like Austin is that I don't want to say the intellectual capital isn't as strong as it is in the Valley. It's just a little bit harder to find the type of talent that they're trying to recruit. So you're trying to find software developers that want to work 70, 80 hours a week. You're not going to really find that right now in Austin right away. That's going to take time. And so I think a lot of folks who are migrating from the Valley love the atmosphere, love the energy, love the just the newness of a place like Austin, but they are being humbled in the sense that it's a little too patient and a little too slow here compared to the Valley and New York City.
Got it. Let's talk a little bit about.
It's a painful topic, Marcus. I was just doing taxes. It hurts when you think about what you could pay in Texas.
It's a beautiful place.
Is way too close. But I'll say one other thing. Tom, a lot of the things that I think all of us are experiencing are happening on a real-time basis. I mean, a lot of us have a lot of different companies, and things are happening that you didn't expect in the early days. Certainly March, April, May, June, July, you expect certain things, and then some things surprise you. For example, we invested in one of these QR code tracking companies for cannabis that tracks all the, packaging, bottling, consumer products, everything else. When the guy was selling us the deal, he was like, look, if you go to Asia, they use it everywhere. And in America, nobody uses the QR code. And then COVID happened, and it was a company we didn't even think about having a tremendous benefit. We're thinking about all the other companies. And then as you get back into the restaurant atmosphere in a month or two, you don't see menus anymore. Every single person is having to use their device to get menu.
Yeah.
And so, you're constantly being surprised with when these markets start to open up, how that impacts your companies. And it's happening, and I'm sure everybody agrees, on a weekly basis. You realize something, and that's a good case where, a lot of folks that didn't invest in that deal, is Elizabeth and Marcus were talking earlier about a deal. One of them did fun, actually, when you have friends that are doing deals and you didn't. In this particular case, no one did QR codes. They didn't think anyone was going to do it. And now all of a sudden, you're having people in this country and all over the world have to be forced to have new habits and learn new habits, which I don't really know the full ramification of yet. But the real answer, Tom, is that every week it seems to be surprising right now.
All right, thank you. On a different subject, but following up, since this is a COVID conversation, I'm wondering how you are dealing with meeting new founders where you're unable to do as much travel and face-to-face. Has anybody had an experience? Can you share with us how you're, kind of changing your practices to deal with that? Elizabeth, maybe you have some ideas?
Yeah. So one of the things that I've always done is I've very much integrated my work life into my personal life. And many founders I lure to the trails of Portola Valley where I live to take a 55-minute walk that fills our same hour block. And I don't like coffee. I was joking. I run on Diet Mountain Dew, which is my own problem. But moving that from traditional grabbing a coffee to going on a walk has always been this much more personal experience for me anyway. So I miss that piece of it. But for me personally, it was very easy to get comfortable meeting people on Zoom and knowing that I need to make decisions that way. I know it's been harder for the LPs that I've talked to through this similar phase. That said, I hate sitting in my office and being plugged into Zoom. So I've also just created more of the practice where I'm bringing people into my world, and I will go on, if it's a meeting that I don't need to be taking specific notes, for example, but it's more a get to know you, hear the founder's story, hear that pitch, I will show them me that I exist, likely in my running clothes and my baseball cap, and say hello personally, but then ask permission to, if you're okay, I'm going to get outside for a walk. You probably want to do the same. I'm going to put you in my pocket. And that's created this similar relationship where I think the founder gets to do the, I don't have to talk to a stodgy investor. And it's still been able to build and cultivate relationships throughout this very weird period. The last point I would add, I have a 5-year-old and 3-year-old twins, so I am totally bored at home, as you can imagine. And the fact that many of us have been, I call it Zoom bombed, but Zoom bombed by our children, I think it adds this new humanity to life that none of us have been willing to integrate into our work worlds because we've been scared of that. And I know, as you know, a female and one that has given birth, had to breastfeed, be pregnant throughout periods of working with all men around the tables I've sat at, primarily, it's been very refreshing to see other people having to integrate their lives as well. And we're all going through the same struggle right now. So quite democratizing.
Yeah. Has anybody else found any creative ways to meet with founders and get to know them to a degree that you're comfortable making an investment in their company?
Yeah, I've worked out with two founders. And so we've had like a socially distant workout. And I think for me, I hate to say this, but I've actually traveled a couple times also. And it's because I think for me, Elizabeth has an incredible pedigree, as she said in the call. Like, she's worked for some of the top venture funds in the world. And, she has an incredible track record.
Did my time. I'm just normal though.
I think for me, as kind of a young guy who's just kind of cutting his teeth in this space, I'm competing against some tier 1 Silicon Valley funds for small allocations and deals. I kind of got to be really, really scrappy. And so if that means I get on a plane, come see you just for us to be 10 feet apart, just so I can show you that I'm willing to do that, I kind of have to do that. And that's what it's been all of COVID. And I don't know, for me, it's been refreshing. The workouts have been great, but like for me, Zoom is just, because I'm just so new and so kind of energetic, I got to find unique ways where I'm in person talking to you. And some people have a problem with that, and it is what it is. But I know for some of our LPs that we've closed on, they're old school. They're like, hey, we need to break bread. So we can break bread 15 feet apart, but we need to break bread in person. And so that's kind of how it's been for me. And like I hate saying that just because a lot of people have been very responsible and smart and staying home. But we've had to be unique in how we do things.
Good. Homan, how about you? I was curious if dealing with people remotely or virtually, does it affect how quickly you're able to make decisions? Do you get to yes or no quicker than you used to?
That's a good question. Our diligence process has actually been about the same length. In some weird ways, like Zoom has helped because we don't have the logistics of going to meet someone or having to set up the conference room and all that fun stuff. So we can have more meetings or more frequent meetings. What we have done is actually a lot more reference calls, whether they're asking them for references or blind references, just to, because we know we can't meet in person, let's say 6 times. I mean, we don't always meet that often, but just get a feel for the person. We kind of get it from other people to get a feel like, okay, is this person hardworking, reliable? How do they deal with pressure? All that fun stuff. And of course, at the very end, if they are local and they're open to it, we always ask them, hey, if you don't mind coming to the office, we have a pretty big parking lot. We'll set up 2 picnic tables and we'll share a beer, 10 feet apart, which we have done before. So yeah, I would say time to diligence is still about the same. It's just more touch points with references in themselves.
Thank you. Matt, I'm wondering, has anything related to COVID caused you to think about your portfolio construction in a different way? Are you changing anything directly related to COVID, or is that not relevant?
Yeah, I think we all have to. As Elizabeth said earlier, I think if anything, it's expedited the fashion with which we're putting capital to work, because it's opportunity to be able to drive structure, in our space in particular, in an emerging industry. And, emerging industries tend to look the same. I mean, you have the up, 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 down, and then you reach a point and you have the big down, then you have the long, upward trend. And, not too dissimilar than Andreessen in the 90s. Our thought when we've managed funds for a long time at a lot of places, our partners' background, Goldman, Cowen, Guggenheim. And when we saw the emerging space with cannabis, we said more money than ever is constantly going to fewer firms, and they're very hard to compete with. Marcus was talking about this earlier. You've got to find a way to differentiate yourself and compete, but it's very difficult because in a certain space, managers have been managing strategies for a long time there, and it's hard not to have the capital flow to those folks. I mean, Andreessen, for example. But if you go back to the late 90s, Elizabeth would know this, 95, how many firms were specifically set up to only invest in technology and internet? Not that many. And that's why we did this in cannabis, because frankly, there's 15 equity funds in the entire world of this industry that does 20 billion in revenue. There's just no one to do the work. And frankly, there may be only 5 to 7 really good firms. And so back to your question, Tom, we wanted to be a specialist from a deal standpoint. It's any company out there can just Google who are the, investors in cannabis, and they're only going to find 10 of us. And so it's impossible for us not to see a deal, because much like Elizabeth would probably tell you in the Andreessen day, in the early days, you're all working together. I mean, you're co-investing, and all the big funds at that time are doing deals. And it's in everyone's best interest to make sure that you ensure that the industry gets de-risked and move forward to the next, class of investors. And that's what we're doing here. So amongst all the investors in the industry, we're on WhatsApp groups. And again, there's only 15 or 20 firms. So it's impossible for a deal to happen in this industry, and the growth stage at least, without us knowing, specifically because you can reverse engineer from that 20 billion number. And we basically can go out and ask companies, hey, we see you're doing this. We have the data. We know exactly what's going on. Here's what you're doing. How about you do a round? And so in many cases, Tom, we're actually going to companies and saying, it's time for you to do a round. You've got 5 or 6 of the big funds wanting to do your deal. Here's how we want to do your deal. And so from a structure standpoint, this is what's really remarkable about it. For 16, 17, 18 in cannabis and hemp, you could go to different markets and get access to capital. It was not this country. It was Canada. Bay Street's different than Wall Street. Frankly, you can do almost anything you want there. No rules, basically. And that didn't do very good things for these companies as they were structuring deals. But that's gone away, and this is really in the hands of real investors that are doing, growth rounds and building companies. Now these companies are forced to listen to us a little more, and they can't not do a deal with us if they want the funds, because we all talk. Mm-hmm. And so basically we get to go in and say, we're going to have a different corporate governance structure. We're going to have forensic accounting. We're going to, maybe even tranche capital. We're going to do on-site field examinations. And they accept it all. And many times they say to us, Tom, they say, you guys know the industry. We're not going to tell you what we're worth. We need to do around here. Here's our numbers. Here's our financing. How about you guys take all that and come back to us and make sure we get 3 to 4 of the top funds in the deal, and we get to basically draw it up. And that's remarkable.
That's a nice way to be.
It's a fun place to be. It's a nice place to be.
Yeah. So you mentioned that you provide advice to the portfolio companies. Again, I'm trying to bring this back to impacts of COVID. So what other types of leadership or advice are you giving portfolio companies? Homan, do you want to grab that one?
Yeah, I mean, we've told them that you have to be very adept at, adjusting to the times. I mean, early in the days, we told them, hey, be very cognizant of the burn, but now everything's accelerating, so you have to be very aggressive on the growth. And I think we said, make sure your team's good. Culture is super important in a startup, and being remote, it's a different set of worms, can of worms you have to deal with. So yeah, we're very, very active about that. And then also just telling them, hey, like, even for this year, if you need to raise or you think you need to raise, people are just burned out. So we think between election happening in November and then people burning out in December, you might not be able to raise until January next year when people figure out what the hell's going on. So, just trying to tell people to think ahead, be nimble, and, really just don't have any preset notions of how the world's just going to be over the next half to 1 year.
Yeah. How about you, Elizabeth? Anything?
Well, I've been spending a lot just on the cash is king, and really planning that timeline and horizon, and something I hammer on with all of my founders.
Yeah. And what about your board meetings? How are you handling board meetings? Again, with just doing everything virtual, or using the same tactics, traveling Marcus when you need to, and how are you handling it?
Everything is virtual. Yeah. Well, actually, this is Texas, so we actually have for one of the companies, we have we're going to a gun range in 2 weeks for our board meeting. And so, yeah, they thought it's the most socially distant activity out in West Texas. And so that's a unique way, but most of our board meetings have been virtual.
Right. And are the meetings being held, with the same agendas as they always were? Are there anything different or new that happens?
It's about the same. It's been generally about the same. I think one of the things that we have tried to do as kind of a, newer, younger fund is just say, hey, it's okay. Like, don't feel like you need to put on this face because things aren't great. Don't feel like you need to put on this face because you're burning through cash. You're probably going to have to raise a bridge round pretty quickly. Don't feel like you have to put on a face because you've had to let go of 2 of your rock star hires. It is what it is. It's part of life. And I think what COVID has done for not just like our industry, but for people in general, it's made us more human. It's like Elizabeth was saying, she has a 3-year and a 5-year-old twin at home. It's like, hey, it's okay. Like, shit sucks right now. Don't put on a face. Like, we all understand that there's a good chance things don't work out, but we're going to be in this together. And so I feel like our board meetings have been more productive and more fruitful, quite frankly, just because it's just more human. It's more just we're all in it together.
Yeah. How about the investor side of it, your LPs? You have to do investor relations. Generally firms do some travel, they get out and have face-to-faces with LPs, maybe tie them into meetings that they're doing with portfolio companies, fundraising. How is all that working out? That must be a challenge as well. Elizabeth, you're fundraising now, right? You've had to do a full fundraise in this environment?
Yeah, we kicked off. Well, I figured there's no worse time in history to start a fund, raise a fund, and I was also embarking on the summer. So I thought, oh, I've got 3 strikes against me. I could at least blame it on a lot of things if this doesn't go so well. But I think one of the trends that all of us are seeing, both for better or for worse, I know personally, is because our work lives are merging into every hour of our personal lives. I found our fundraise extremely efficient. So I technically started talking to folks in June and are wrapping up right now. I feel very fortunate for that. But I think people were willing to hop on a call when they could do it from their Nantucket home. And their other partner was still back in their normal spot by the office. So that made it much more accessible. That said, I think that the LP side of the world has taken and is still taking a bit more time to get comfortable with the idea of being able to deploy a large amounts of capital to funds that they have not spent time with the people. What I've heard from a variety of LPs throughout this process is one of the things that the teams have been struggling the most with is that, extra something that they can't really suss out without spending time in person with that. I think that's one of the things that I really do is just bring my personality into it, because there's, at least through this period, there's no way that they're going to get that in any other way. And I think it's something that we've just all had to adapt through, but the efficiency has been helped by it. I think even to your earlier question about board meetings, I think the organization has had to take place a bit prior. I know my founders have been more prepared for times when we know we're hopping on a Zoom board call or meeting, because instead of it being just a conversation in a room for the entire period, it needs to be a little more structured because of this format. So I found it unique, but quite productive. And I think, as we all know, raising capital is not always the favorite thing to do, and it usually is not productive. So if Zoom has helped and the COVID era has spurred that along, I think we've got some good things coming too.
Thank you. Is anybody else fundraising? Anybody else have comments about?
Yeah, I could pitch in. Yeah, I mean, we started in January, which is also probably equally bad timing because, as we kind of ramped up, March hit, so everyone just freaked out and stopped. And, as Elizabeth mentioned, I think people started picking things back up in July, August timeframe. But yeah, I mean, in some weird way, it's been somewhat helpful because you don't have to deal with all the travel. There's just no option to meet people in person. Even if you ask them if they want to be in person, they don't want to. So it's just easier to schedule things. But it is definitely harder for, I think, maybe newer contacts. They're just focusing on existing people that they know, existing fund managers. And so that's been harder to kind of get into that ring. But for the people we've been talking to for the last few years, they're like, yeah, we don't need to do it on site. We've been talking to you for 2 or 3 years. Like, we kind of know you. We've already visited you. So it kind of swings both ways. But just the logistics standpoint, I think it's been easier, not having to deal with flight cancellations and, Ubers and all that fun stuff.
How about you, Marcus?
Yeah, so we've been raising for a couple strategic vehicles, and I would say COVID definitely impacted it because we started probably towards the tail end, or not the tail end of COVID, but we started towards like maybe June, like Elizabeth. But I think we were fortunate in that, just candidly, there's been this giant D&I movement recently, and so now you have a ton of LPs who are like, we need to find diverse fund managers, and we just happen to be diverse fund managers. And so, whereas you had the struggle of COVID, well, now you kind of have the fortune of all these funds and companies allocating, X amount of money towards diverse managers. And so we've been fortunate to kind of receive the tail end of that. And so that's helped our fundraising. But as far as communication, that I would, just being completely transparent, I would say that's definitely been the hardest part for me to kind of learn and understand, because you don't want to be over communicative, but you also don't want to be under communicative. And it's like, there's kind of this imposter syndrome where you're like, wow, I shouldn't even be talking to this endowment or this LP right now. So I'm now thinking to myself, let me wake up and put on a tie as I get on the Zoom. And then you realize this person doesn't care about your tie. This person doesn't care about you. They just want to, but you're still dealing with this idea like, oh my God, how do I present the best version of myself while I ask for a large check? And so that's kind of been our kind of, like, I don't want to say struggle, but our journey in fundraising during COVID.
I want to bring you back in, Matt, even if you're not fundraising right now, but I was wondering where, as you mentioned, some of the LPs don't even want to meet with you in person. Do you find that they're using consultants more often, the Cambridge Associates and Stepstones of the world, and just kind of dishing the process off and letting somebody else make recommendations for them?
Well, Tom, not so much in our industry, just because of the nature of the regulatory environment. You don't see a lot of the normal things you would see. But I will say too, we're always raising. I think fund managers, even if you're not actively raising, you're always raising. I mean, you're thinking about that and you're positioning things, and whether it's for an SPV or one company or fund, I mean, I think you're always of that mindset. And frankly, I love it. That's all I want to do. That's all we want to do is raise capital, because this industry we're in, Tom, is so unique. And it's not technology, it's not science tech, it's not, technology, it's human technology. We believe we're making the world a better place. I love our panelists here talking about this human element during this time, and boy, is that real. But when you're doing things to bring people medicine and make their lives better, they're finding it and insatiably growing this kind of like human by human element. That's how this thing's growing. You just feel so compelled, and there's only so many funds, as we talked about before. And I feel like as a group, we all have a responsibility, and we feel it, to go out and make the case to get more of these professional services, have, institutional allocators. As today stands, we're less than 5% across the whole industry representing institutional capital. So those normal, lines of service, Tom, are not available traditionally, which creates opportunity. But I would say that the managers in this space are feeling like this is more than just a way to make money. I genuinely can tell you, we all feel like we're doing really, good thing for humanity. And so we're all together in this, trying to break through that glass ceiling, if you will, to get more capital to flow into this space. And I think we're going to see a flurry of activity after the elections, no matter what happens.
Great. How about annual meetings? Has anyone had to skip an annual meeting, or did you do that virtually as well?
Attended a number, and what I've found, firms are not skipping them. They're doing them via Zoom primarily. I've heard of, well, one, I think they're more efficient, which again, I don't think is horrible. Missing some of the socializing time, which depending on which LP meetings, some are quite fun and some are, you're happy to have it on Zoom. But the thing that I've heard from the LPs that have hosted, and I've been the attendee, I've said, what's been the biggest change? And the thing that has been reoccurring is that they're getting less questions from their investors. And I don't know if that's just the format, or if somebody doesn't want to ask that question blindly when you don't see who else the other attendees in the audience are. But I thought that was an interesting point.
Anybody else have any experience with
on that topic, we found this to be quite an advantage, having everybody adapt to this virtual life, because we've done more meetings for our current LPs than we do normally, because we didn't do them virtually before, and so we do them every quarter now, and our annual we're pretty excited about. So I think you're able to convey more information in a certain sense. And then on the other side, from meetings we have to attend, board meetings, everyone's talked about, feel the same way there. They feel more, they just feel encouraged to have more conversation and dialogue than ever before. I would say, as a general statement, on both sides, because of virtual and flow, year than maybe ever before.
Okay.
And then also I would add that with some of the enterprise tools that have been developing, where I know, for example, we're in a company last year invested in pre-COVID, which has been interesting to see mature, but a company called Run the World. And think of, they are bringing in life conferences online, but how do you convey and create those experiences that are much more typical at an LP meeting, where you take your glass of wine and you talk with just one or two people and have a smaller conversation, and those tools are being built into the things that we're using every day. So being able to simulate more real life, I think, is only going to get more advanced.
Great. Well, we've reached the end of many of the topics I had lined up for you to discuss. Our audience today is based of a lot of people in the venture capital industry, but we also have a lot of people that are at the portfolio companies themselves, CEOs and CFOs. So why don't we just kind of go around the horn and see if you have any advice for people of that audience, like what should they be thinking about if they want to either raise their first round of venture capital or do additional fundraising for the next round. Want to start, Homan?
Hire Cran.
Oh, go ahead, Matt.
Uh-oh.
You're breaking up a little bit, but you there, Matt?
I was saying, hire crayons is the. Can you hear me?
Yeah, I like that. That's a good start. Go ahead, Homan. You start first.
No, yeah. I mean, I try to be, very open with the founders and kind of explain to them what the process is and what we look for and how things are maybe different now as we kind of look at companies. But yeah, I think just trying to be very, very open and transparent, and give them feedback when we can. And it's different in person. I know for them, they don't get the same input as well, and so. Like we kind of hit on the many themes, let's try to be more human, more understanding of just what's going on these days. And just, it's hard for everyone. Like we're fundraising and founders are fundraising. And so we know it's hard. And I mean, even just on a more tactical level, I tell people, hey, I've definitely noticed when we're pitching our fund, like people will zone out after 30 minutes if you're pitching. After that, their attention is just gone. So try to get your message very concise. And if you want to have more follow-up meetings and phone calls or walk-in calls, that works very well. But you have 30 minutes, unlike in person where you maybe have an hour meeting and you can shoot the shit a little bit and all that fun stuff.
Elizabeth, you have any thoughts about that?
I think because we have such limited time to convey your message when you're out making that first pitch, being a little bit more buttoned up and clear in conveying that info, even if it's the start of a deck that can seed that conversation. And again, I think because we're all needing to take signals from additional areas to just in-person meetings, having warm connection points actually help make those introductions and connections to the investors that you're wanting to pitch. So I have been much more, I think there is no lack of deal flow right now, especially at the early stage or or any companies that are going to market for capital. So I think getting that targeted intro is even more important than it has been, and I do believe it's always been important.
Yeah. How about you, Matt? Do you have any thoughts? And I'm wondering, are there any no-nos? Is there anything that you should warn CEOs and CFOs of companies to not do when they make a presentation?
Yeah, one size does not fit all. I mean, get back to fundamentals. And there's a bunch of athletes on this phone. Tom, I want to hear about your past too on that topic, but you got to get back to fundamentals. We talk about it in life, you talk about it in sports, you talk about it in business. Make sure that you understand who you're talking to. When you get a chance to pitch something to an investor, do a little homework, come into the meeting and don't have a boilerplate. Okay, our time started, listen to me for 30 minutes. Start a dialogue, understand who the investor is, maybe where they went to college, add them on LinkedIn before you get on the phone. I mean, the little things, and then listen, ask questions to the investor. because you'll be surprised what you hear. And so I think just get back to fundamentals, proper valuations. As we talked about earlier, Tom, and you made a comment, you know, in terms of turning that into COVID conversation, what I meant was go to investors and talk to them about your round. You don't have to pitch them and sell them something. You can work together. Who is your investor is as important as anything, because they're going to be so valuable and they can cause you problems. You want someone that can add value and not take away from you. And so you really need to understand who you're talking to and be able to talk to them as, you know, from the seat that they sit in, but also be willing to adjust your plan. If you get the right investors on the phone, you don't have to have a one size fits all. You can adjust and you can, you know, you can reverse engineer in many cases. So that would be the biggest thing right now, Tom, just making sure you go into each pitch meeting, you know, as its own standalone meeting. And lastly, I brought up Crayons Consulting. It's a real thing, because if you're raising a first fund or you're raising whatever round you're raising, you've got to ensure that your service providers are first class. Don't skip on the legal work, on the tax work, on the audit work, on the structure work, because that will come back and get you. 100% it does at some point in time. Either it'll hurt you on evaluation later on, or maybe even worse, you'll get in real trouble. So don't do it now. Stick to fundamentals. Spend the time on service providers. Make sure you're buttoned up, and then each investor should be their own meeting.
Well, we agree with that. That's for sure. And we have the people to help.
One more thing I would add, though. I've seen too many founders create their pitch entirely around why they're going to succeed because of COVID. I think we want to see these still as a standalone independent company that is built to last despite the environment. So I would hammer on that at this point in time.
Excellent. How about you, Marcus?
I don't want to kind of hash what everybody else said. I mean,
Okay.
I would say ultimately on the more human front, just have some grace and have empathy for people. I think everybody's trying to adjust to this new normal. And sometimes a founder or an investor may not get back to you right away. Sometimes an investor may be kind of short in an email or a LinkedIn message. Just understand that they're juggling a lot of inbound, just like you are. And they're just, and to, you know, jump up what Matt said, your service provider is everything. Whether you're a venture fund or an entrepreneur, like first class service providers will change the world for you. And it's a tough lesson we had to learn pretty early on. But I think just partnering with the right people really early speaks volumes about your company before your company is even a real company. So
Awesome. Well, if you're ever in any board meetings and any of your portfolio companies need any accounting services, you know where to go.
oh, for sure.
So we've got about 10 minutes left. We'll see if we have any questions. We have one here for Elizabeth, and the writer says, can you speak to your approach to managing your portfolio companies? Are you very involved in the management of portfolio companies?
I think it depends on the founder, to be honest. Some companies, as you can imagine, they are in their head, especially in the pre-seed, are very heads down and they're in just build mode. And my biggest role as an investor in them is blocking the inbound. And when I have other investors that said, I hear early great things about this, can you intro? Being able to convey that and really let that team work. Others are leaning on me daily. I have texts and emails that are just little check-in points. And for some teams that works well. Some have done more a regular cadence check-in and know that they need to be held accountable through things, but want to be buttoned up and use that as almost a mini board meeting. So it absolutely varies. And I also would say it varies with personalities as well. In addition, I think portfolio or fundraise construction is so important. So that's a piece that I very much get involved in because of my background with the institutional venture community and knowing those players and those people. So I think depending on who you put around your table, as long as you have that support network in place, certain people or certain investors in your round will flex different, I say, superpowers at different points in time.
Thank you. There's another question here that says, in the first pitch meeting, do you expect to meet just the founder or the entire team, including co-founder, advisors, et cetera? You want to handle that one, Homan?
That's a good question. I think, every firm will be different on how they approach it. For us, I mean, it's still somewhat similar with Zoom, but definitely was the case in person. It's it's a little weird when you bring like 10 people to your pitch, right? It's just the room is so big, it's so intimidating, and it's hard to have intimate conversations. So for us, we like to, at least for the first meeting or two, just see the founders, right? 2 to 3 people. I understand there's obviously other good people within the team, but I think that's part of the diligence process, that we can meet them afterwards. We really want to meet the founders, understand how they work, how they tick, how do they interact, and really understand the vision, right? And I think it's better done with a smaller group as opposed to a larger group.
How about you, Marcus? Have anything to add to that?
I agree. I think smaller is better. It's more intimate, less kind of crowd, because then, somebody starts talking. It's like, well, I want to add to that. I want to add to that. I want to add to that. And before you know it, it's like you have 7 different opinions. When I just think, and same, I'd love to ask that same person, how would you feel as far as talking to a fund? Would you want to talk to one of the partners, 2 of the partners, 3 of the partners? I think you'd prefer to talk to one of the partners, just so you can have a more intimate feel. And then, as you go to next steps, include more people in the process.
When you're making an investment decision, how do you handle it with your partners? What I'm trying to get at is, do you have a formal process of voting, or do you do it simply by consensus? How do you get to yes? Matt, do you have any co-partners?
Yes, we do. And, investment committee is the answer. And, the bigger you get, the more money you raise, the more important that process is. And it's very important to large allocators and the regulators to a certain degree. I mean, everybody here, I think, qualifies for venture exemptions, but as you get bigger and move into different structures, that won't be the case. And it becomes very complex. And again, why you need grants. But, I think in general, having the right service providers is going to get you there. But I think we're remaining pretty optimistic.
Yeah. Elizabeth, do you guys do a formal vote? You're one of 3 partners, right?
Yes. So this was one of the things that was so fun about creating my own firm, and just taking the best of the places I've been, because we are a team of 3. On process wise, one of my partners is also a runner, and we spar on these ideas over runs, which is always quite fun. But I think with the pre-seed and seed stage especially, the independence of thought is so important. So we have it as a very crisp rule that we do not have to have consensus from the team, but oppositely, somebody needs to be pounding the table. And if we're all meh or that's not going to get a deal done, even if we're warm or positive, generally. So having some clear indication, because we really do believe that the best ideas are those ones that seem like an outlier and seem impossible. So that there has to be space built into the model and the decision-making process to take care of that.
Yeah. Homan, do you take a formal
Tom,
vote? Go ahead, Matt.
Tom, if you would let me check. I think it's a great point. What I failed to extend upon was that depending on the type of firm you are, right? Because we're a little bit more of a growth investor, so it's really more based on a process that goes through the investments team. On my side, I probably shouldn't even see a deal until it gets to investment committee. The less I know about it, the more I can look at a black and white piece of paper that has all the details ironed out in the way it's supposed to be presented to investment committee and make an unbiased decision. And so we have different partners that sit in different ways. But the further along that you invest, I think it becomes more important that you have a uniform, formalized process that different partners see it at different point in times, and do not get involved early, because frankly, if you get emotionally invested in a founder or a deal, that can sway your decision-making process. And I think, we don't want that to be the case for everybody. Some people need to look at it, make a decision without even knowing the founder in a growth investment.
Okay. Homan?
I was going to say, for us, we're early, and our team generally sees everyone, at least from the second or third meeting on. And we do have a voting system where it's out of 4, 4 is strong yes, 1 is strong no. We have it so that you can never be like a 0.5. So you have to be on one side of the table or the other. And typically, yeah, definitely someone has to be pounding the table. Someone has to be a 4, usually the person who brought the deal in and wants to push it through. If someone is a 1, like a strong no, that could be also a reason to kill the deal. But, we kind of allow everyone to have a silver bullet. But, I think in talking through the process, everyone understands where everyone's at. And so it just comes down to end of the day, like, where does everyone stand? And usually there's, at least 1 4, usually most everyone's a 4 at the end of the day, as the diligence process runs its course, or vice versa. People go from a 3 and then down to a 2 or 1.
And Marcus, how about you?
Yeah, similar to everybody said, we're a small team, so we all got to be bought in. We like to think like a football team. It's like,
so
hey, listen.
It needs to be unanimous then? Both of you have
Exactly. It has to be unanimous. We like the benchmark model. Everybody's partner. Everybody needs to be bought in because we all have our hands on this. And if this goes bad, we all need to be held accountable, not one person in particular. And so that's the model we go with.
Let's see here. Somebody says there's questions in Q&A. How am I doing that? Auckland, can you help me? Do you want to read these last questions?
Sure. The first question that came in is asking, how do you respond to the first and second questions for later stage companies, Series C, i.e. engagement, cadence outside of the funding round? Thoughts around meeting the team, feeling the team dynamic during the late stage funding round, given the current climate?
Who wants to grab that one?
Well, I guess we'll jump in because we tend to do a little bit more of growth, and the data room becomes extremely important in later rounds. As you hear everybody here talking about, if you're doing a seed or an angel deal, you all got to be on board. You have to know these founders. You have to believe in all this vision that they have. But as you get to a C and a D round, all those things are important, no doubt about it. But if you take the time to build out your data room so that everything's in there and you just flood it with great information, that is the best way to go in that round, because it's less, and I hate to say this because we're all about the entrepreneur. Marcus said this, till death do us part. We're in it to the end, no matter what. We're long-term equity. But if you're entering a round or doing an extension or a follow-on to your current round, it's going to be more about the facts and the data. I mean, we're not trying to be private equity. We're not doing Apollo deals or something. You still have multiple rounds you're going to be in. But I think you have to, this goes back to understanding who you're talking to. If these 3 fund managers talk, they just told you how they do their deals and who they need to talk to. If you came to our fund and you got a hold of me and you try to pitch me your deal, it's going to largely go on deaf ears because it's going to have to go to the investments team and they got to run a process before it comes back. So just understand where you are in the deal, who you're talking to, what type of investor they are, and be prepared for that moment. And I think that's really critical.
Thank you very much. The last question is, are you all willing to look at deals that we introduced to you right now, or do you have too much deal flow?
Depends on how good it is.
Yes. You can never have too much deal flow. That's our job.
Oh, yes, you can.
Well, yes.
Well, listen, we're at 11:01, so we've used our full hour. I want to thank all of our panelists, Matt, Elizabeth, Homan, and Marcus, and thank all of you that tuned in for us today. And thank you so much. See you again another time.
Bye, everyone.
For having us.
Thank you.
Thank you, everyone.
Bye-bye.
Bye-bye.